In this video, I want to talk about momentum-based exchange-traded funds. How to ride the market's hottest trend. Momentum-based ETFs, that's an exchange-traded funds, are designed to capitalize on the momentum investing strategy, which involve investing in assets that have demonstrated strong performance over a certain period, with the expectation that the trend will continue. So here is a breakdown of key aspects of this strategy. Number one is momentum strategy. It focuses on assets such as stocks or bonds that have shown strong recent performance under the assumption that the trend or the performance will continue into the near or distant future. Number two is dynamic allocation. Dynamic allocation. So you regularly adjust holdings based on performance metrics and trends, often rebalancing on a monthly or a quarterly basis. When you key into a particular trend, you need to rebalance, review your portfolio regularly. Number three is index tracking. Index tracking. Momentum investing actually, has to do with the ETF concern. Tracking indices, especially or specifically designed to include securities that exhibit momentum characteristics. So you have to make sure that the securities involved are the type that have displayed or continue to display momentum characteristics as they are growing at a faster rate, and you believe that the securities involved will continue to grow at that rate. So you may also track the market index in this regards. Number four is quantitative models. It uses quantitative models and algorithms to select and weigh the securities based on the momentum factors. In this case, you can even employ algorithm and probably a little bit of AI, to select and weigh the securities in the bond portfolios based on the fact that they possess momentum characteristics. So let's highlight the benefits of this strategy. Number one is potential for high returns. It can offer the potential for significant returns by investing in assets that are trending upwards. These assets must be trending upward before you invest in them, because it's all about momentum. It's all about upward swing, upward movements, and that's ultimately will bring about a potential for a relatively high returns. Number two is a systematic approach. So provides a systematic, rule-based approach to investing, which can reduce emotional biases and subjective decision making. So this particular strategy is focused on logic, on reason, and when it comes to emotions like greed and fear and biases, behavioral biases, all those things, all those factors don't count, because the procedure is highly streamlined, and there's high level of discipline involved. Number three is diversification. It allows investors to gain exposure to a broad range of momentum stocks or assets within a single fund, enhancing diversification. But the fact that you invest in a broad category of stocks, many stocks that display a singular characteristics, and that is momentum. So you end up getting sufficiently diversified as a result. Number four is flexibility. It offers exposure to different asset classes or sectors, showing strong momentum, adapting to changing market conditions. When it comes to this particular strategy, you are more concerned about the asset class displaying uh, momentum. When you invest across market, when you invest across asset classes that displays momentum, you discover that it guarantees you, it gives you flexibility. You're not really tied down to stocks alone, but rather the fund involved, the ETF involved, invest across different asset classes as long as the assets involved displays diversification. So let's look at the drawback of this strategy. Number one is volatility. Momentum strategies can be more volatile as they may concentrate on assets with high price swings. So volatility is inherent in the system because the assets they are invested in kind of displays considerable amount of volatility. Number two is reversion risk. The momentum effect may reverse, leading to potential losses if the trend turns against the ETF holdings. Usually, stocks or assets don't grow to the sky. There's that principle, there's that theory of reversion to the mean. And so once it gets to a particular level, it encounter resistance, and then it will start dropping, reversing to what the actual price, the intrinsic value should be. So that reversion to the mean actually will then cause investors or the ETF to incur losses in the constituent portfolio stocks. Number three is high turnover. Frequent rebalancing can result in high transaction costs and potential tax implications for investors, because the fact that they are always turning over and turning a portfolio to be able to meet up with to catch up with momentum to catch with securities that shows or indicates momentum, then of course it leads to higher transaction cost. This particular stock is showing momentum, you buy. That other asset display momentum, you buy. The other one has lost momentum, you sell. The other one is about to display momentum, you buy. So all this buying and selling actually, leads to high turnover, and the high turnover here is inherently would involve higher transaction cost. Number four is performance dependency. Performance dependency. These are reliance on past performance trends, which may not always predict future success, and the strategy can underperform during trend reversals. Trend will always reverse. A given trend can never continue forever. It's almost virtually impossible. So watch out for those, expected reversals, because when it happens, it will certainly affect the portfolio companies of the ETFs involved. And so generally, this particular strategy is dependent on performance, but performance cannot continue forever. That's why in a typical investment, they will warn you that past performance is not indicative of future results. So you are doing everything based on past performance. The future may not really, be the same as the past. So whenever there's a reversal, definitely it will affect your investments. So momentum-based ETFs offers a targeted approach to investing based on recent performance trends, but they come with their own set of risks and considerations, particularly around volatility and market reversals. That is the danger of this particular investing. As much as it provides higher returns, it can also, the asset class involved can undertake a kind of reversal, and then that will result, in losses. Please subscribe to this channel if you've not done that, and give this particular video a thumbs up if you've watched this far. I appreciate your patience.